Hey, it's Max from UNFTR reporting for the MeidasTouch Network, and today we're going to head south of the border, across the pond, through the woods, and over the rainbow to follow the meandering and nonsensical foreign policy and economic maneuvers of President Trump. Now, in the president's sights at this moment are BRICS member nations, and specifically Brazil, who had the audacity to gather recently and discuss global economic policy during a time when, admittedly, the biggest player in the game is acting irrationally and irresponsibly. And in response, President Trump took to Truth Social to offer an irrational and irresponsible response. Now, as usual, there's way more to this story than trading barbs on social media. In fact, the United States is playing a very dangerous game right now, and the economic data are beginning to betray the Make America Great storyline. So to break it down, we're going to talk about tick data, BRICS alliance, Forex assets, de-dollarization, repo markets, tariffs, inflation, and something called the Washington Consensus. And if that all sounds like gobbledygook, I promise, in the next 20 minutes or so, you'll be more informed than all of Trump's cabinet. So let's go. Okay, so let's get out of the way what's really happening right now. Trump is using his defense of disgraced former President Jair Bolsonaro as a convenient smokescreen to pick a fight with Brazil. But the timing tells us everything we need to know about his real motivations.
And certainly Trump has, in the past and frankly in the present, tried to craft these alliances with these sort of unsavory autocratic figures, of which Bolsonaro is one.
Bolsonaro, for those who need a refresher, is Brazil's former president who Trump personally admires and wants to see freed from charges by the Brazilian government. So Bolsonaro's facing legal consequences for inciting an insurrection in Brazil that bears striking similarities to the January 6th riots here in the United States. Birds of a feather and all of that. But here's where it gets interesting. The timing of Trump's threat to slap a 50% tariff on Brazilian goods is markedly different from all those other boilerplate letters that he's been sending to nations that haven't negotiated trade deals with his administration. 90 deals, 90 days. Anyway, this isn't just another trade tantrum. This is strategic economic warfare disguised as trade policy. And here's the kicker that exposes Trump's fundamental ignorance of basic economics. We already have a trade surplus with Brazil. So let me repeat that for those in the back. The United States exports more to Brazil than we bring in from them. I mean, putting tariffs on a country that you already have a trade surplus with makes about as much economic sense as trying to put out a fire with gasoline. So what's this really about? This is a calculated scheme to punish Brazil for serving as the current head of the BRICS alliance that recently convened to discuss moving forward with a comprehensive and cooperative economic agreement. And yes, they are seriously discussing the eventual rollout of a BRICS plus currency that could be potentially pegged to gold. So take a look at this graphic showing the expanded BRICS Plus membership. So we're not just talking about the original Brazil, Russia, India, China, and South Africa anymore. The alliance now includes Egypt, Ethiopia, Iran, and the UAE, with Indonesia representing a particularly significant addition given its massive population and growing economy. These aren't small players we can simply ignore or bully into submission. Now, let's be clear, a BRICS plus currency isn't viable in the immediate future. The technical and political hurdles are enormous, and even the recent summit in Brazil stopped short of announcing any concrete timeline. But here's what should terrify anyone paying attention to global economic trends. These economies are growing, their populations are expanding, and their discontent with unpredictable U.S. policies and Trump's on-again, off-again tariff threats is reaching a boiling point. So when you have countries representing nearly half of the world's population actively discussing alternatives to the dollar-denominated system, dismissing their efforts as irrelevant is kind of dangerous complacency that has historically preceded major shifts in global power structures. So let's discuss something that keeps economists and financial market observers up at night, and that is the slow degradation of the US dollar as the world's reserve currency. Now again, we're not in panic mode. This isn't an immediate threat to our economic supremacy. The dollar will remain the world's primary reserve currency for at least the next decade, if not a little bit more. But our dominance is beginning to wane in ways that have profound implications for our economic future. So let's understand why being the world's reserve currency is actually such a massive advantage, because people talk a lot about that, but we really don't talk about exactly why. So when other countries hold dollars in their central bank reserves, they're essentially lending us money at incredibly favorable terms. So it means that in turn, we can run large deficits. We can maintain lower interest rates. We can exercise extraordinary influence over global financial markets. So it's been described as an exorbitant privilege, and it's one of the primary sources of American economic power. But here's what the data are telling us, and it's not encouraging. The share of US dollar holdings in global allocated reserves just declined to 57.7%. It's not a ton when you look at it on a percentage basis, but it represents on an absolute basis a lot of dollars. Even more concerning is the dramatic shift in sentiment among reserve managers. In just 12 months, the dollar has plummeted from being the most preferred currency among central banks to 7th in preference rankings. This is not a gradual shift. That's a fundamental reassessment of the dollar's reliability and attractiveness. So this graphic shows our foreign exchange reserves over time. And notice the significant decline that began in late 2022. So remember, this is what we hold in our reserve currencies. So initially, the decline that you see in 2022 was driven by the Federal Reserve's aggressive interest rate hikes to combat the inflation crisis, which in turn strengthened the dollar and forced other central banks to sell their dollar reserves to defend their own currencies. But here's what should concern us. Even as the dollar has weakened recently, these reserves continue to decline. So why? Because central banks around the world are actively and deliberately reducing their exposure to U.S. assets. This isn't just about currency fluctuations anymore. It's a structural shift in how global reserves are managed, with less emphasis on US dollar, regardless of the exchange rate movements. So this brings us to the fundamental contradictions in Trump's economic approach that are accelerating this global shift away from American assets. See, Trump is essentially trying to solve a Rubik's Cube while wearing a blindfold. Every move that he makes to fix one problem creates 3 new ones. So he wants to bring manufacturing back to America, right? But that requires a weak dollar to make our exports more competitive. But his tariffs strengthen the dollar by making foreign goods more expensive relative to domestic alternatives. He needs other nations to buy our goods then, right? But he's alienating every single trading partner with unpredictable threats and constant trade wars. Trump needs interest rates to stay high to curb inflation, but he also needs to lower them to energize the housing market and reduce consumer debt burdens. He wants to keep prime-age labor participation high, but his administration is liquidating the federal workforce of exactly those prime-age workers. Plus, he's deregulating AI and investing heavily in its reckless rollout, which will undoubtedly hasten the decline in labor productivity and participation. Put simply, he can't have it both ways, always, all the time. Trump needs both a weak dollar and a strong dollar for his plan to succeed. He needs contradictory monetary policies. He needs cooperative trading partners while he's treating them as adversaries. Most major banks and economists have already substantially lowered their growth predictions as a result of his unpredictable behavior and what we're doing from a policy standpoint. And yet, when you add up all of these policies, here's what we can now expect: low growth, rising unemployment, and rising inflation. In other words, the textbook definition of stagflation. As a result, the world is responding by working around us rather than with us. The BRICS nations aren't just talking about alternative currencies, they're actively stockpiling gold as both a hedge against dollar volatility and a potential backing for future monetary arrangements. So now this chart shows the dramatic increase in gold purchases by BRICS nations, with China and India leading the charge. They're not just buying gold as an investment, They're building the infrastructure for a monetary system that does not depend on American goodwill or predictability. All right, so let's examine the degradation of U.S. economic fundamentals that's happening in real time while Trump plays these dangerous games with global markets. Inflation is moving higher again, despite the Federal Reserve's aggressive rate hiking campaign over the last few years. The job market, which was supposed to be Trump's ace in the hole, is imploding. Initial jobless claims are spiking, job openings are declining, continuous claims are rising, and hiring has already slowed dramatically across multiple sectors. And that includes, by the way, manufacturing, which should tell you just how well this trade war is really going. GDP growth declined in the first quarter, and all indicators suggest that we're likely seeing already further contraction in Q2 as consumer spending pulls back in response to higher prices and more economic uncertainty. Witness the sluggish returns from Amazon Prime Day, which turned into Amazon Prime Week to cover for the underwhelming sales. When you have both high inflation and high unemployment rising simultaneously, you've created the perfect conditions for stagflation, which is a crisis we haven't experienced since the 1970s. And here's why this is a particularly dangerous arrangement. In a normal recession, the Federal Reserve can lower interest rates to stimulate economic activity. In a normal inflationary period, it can raise rates to cool down the economy. In stagflation, these traditional policy tools are useless or even counterproductive. So lower rates will fuel more inflation, but higher rates would crush an already weakening economy. So this means the Fed will inevitably need to do what's called the Fed put, which is to flood the market with liquidity when critical segments of the economy start to break down. But here's the problem. We need that liquidity to flow smoothly through the system, and we're already seeing signs that it's not. So we'll do this next part really quickly because we've already covered the next two charts in previous Midas episodes, but now they're going to make way more sense in context with what's currently going on. So first, take a look again at the most recent Treasury International Capital data, which tracks money flows in and out of the United States. We're seeing net capital outflows. Outflows, meaning more money is leaving the country than coming in. This is exactly the opposite of what you would expect from the world's supposedly safest and most attractive market. And the next report will be crucial in determining whether this is a temporary blip or the beginning of a more sustained trend of capital flight. But here's perhaps the most concerning indicator of all. The Federal Reserve recently had to inject $11 billion into an overnight settlement market known as the repo market. So this intervention signals that there was a short-term cash crunch in the system, and the Fed had to step in as the lender of last resort to help our financial institutions cover liquidity for their daily trades and settlements. So repo market interventions are often early warning signs of deeper stress in the financial system. When banks can't easily access short-term funding, it can quickly cascade into broader liquidity problems that threaten the stability of the entire financial infrastructure. Now, before we wrap up, I want to zoom out but also zoom in at the same time to really bring this message home, because we can keep our eyes trained on Brazil as the head of the BRICS alliance while we also zoom out for a moment and examine how we got here. Because Trump's current approach to Latin America and the Caribbean isn't happening in a vacuum. It's just the latest chapter in a long and shameful history of American economic imperialism disguised as partnership. Our relationship with Latin American and Caribbean nations, known as the LAC region of the Global South, has always been that of the worst big brother imaginable. It's either a story of extreme interventionist paternalism or extreme indifference, with nothing resembling genuine partnership in between. We show up when it suits our business and political interests, and when it doesn't, we either ignore them, while never allowing them enough economic autonomy to pursue true independence, or worse, we just overthrow their governments. I mean, the historical record is just damning. We overthrew the governments of Haiti, Dominican Republic, Puerto Rico, Guatemala, Chile, El Salvador, Cuba, Nicaragua, Panama, even Little Grenada. So we would offer them the hollow promise of protection, like gangsters, in exchange for their resources, and then demand that they build an infrastructure to serve our insatiable appetite for global trade dominance. So originally we called it gunboat diplomacy, then we called it dollar diplomacy, but it's all the same thing. It just, whether you hold their bank accounts or hold a gun to their head. So, we turn them into prisons like Guantanamo, cut-throughs for commerce like the Panama Canal, resources extraction like Puerto Rico and in Nicaragua. We use them as safe harbors for ill-gotten gains in places like the Caymans, Bahamas, Virgin Islands, or we just plundered and destroyed them like we did with Haiti. And when they dared hint of self-determination, we just invaded. So this pattern was codified in what became known as the Washington Consensus, economist John Williamson's 1989 framework that explained the neoliberal blueprint for economic expansion, especially targeting Latin America and the Caribbean. Now, to be clear, Williamson didn't issue a policy prescription for how to approach the LAC. He was just describing how we did it. So the Washington Consensus demanded lower government borrowing, privatization of state-owned enterprises, elimination of trade restrictions, and the abolition of regulations that might protect local industries from foreign competition. So it's economic colonialism with a sophisticated academic veneer. And the veneer was shaped by Chicago school economists, most notably Milton Friedman, who is the primary villain of UNFTR, and a conversation for Meidas for another day. So now when you have all of this context in the back of your mind, it makes Trump's current approach even more ridiculous. We're still operating from the same anachronistic playbook of economic bullying while expecting compliance. So we cozy up to authoritarian figures like El Salvador's Bukele or Brazil's Bolsonaro, leaders who suppress democratic institutions and concentrate power, while we treat democratically elected leaders like Mexico's Claudia Sheinbaum or Brazil's current president, Lula da Silva, with suspicion and hostility. The message that this sends to the region is crystal clear. We prefer dictators who will do our bidding over Democrats who might prioritize their own people's interests. It's exactly this kind of hypocritical, self-serving approach that's driving these nations toward alternative economic arrangements like BRICS Plus, where they're treated as partners, not colonial subjects. So what we're witnessing is a president who is playing fast and loose with the global economy while demonstrating a fundamental misunderstanding of how international markets actually function, how fragile these interconnected systems are, how willing the rest of the world is to move forward without us. This is unprecedented and totally self-inflicted. It doesn't have to be this way. And Trump seems to think that everyone else will just accept whatever terms we dictate, regardless of how erratic or self-defeating our policies become. But global markets don't operate on the basis of size alone. They require predictability, consistency, and mutual benefit, something that we have been the shining example of until we elected a stable genius with a great brain and only the best people by his side. The BRICS nations aren't plotting against America out of malice. They're responding rationally to an increasingly unreliable partner who threatens tariffs one day, demands loyalty the next, and changes policy direction based on social media whims rather than strategic thinking. And all of this is happening at precisely the moment that we're clearly heading into a stagflationary environment that we need to start calling the Trump recession, by the way. It's a time that will be disastrous for the American economy and then by extension, the global economy. Because when the United States catches a cold, the rest of the world gets the flu. But here's the difference this time. Instead of waiting for America to recover and lead the global response, other nations are building their own economic immune systems. They're creating payment networks that bypass the dollar, accumulating gold reserves that provide alternatives to dollar-denominated assets, and they're forming trade agreements that reduce their dependence on American markets. And the tragedy is that none of this was inevitable. American economic leadership could have been maintained through cooperation, consistency, and a recognition that in an interconnected world, everyone benefits when trade relationships are stable and predictable. Instead, we have an administration that views every economic relationship as a zero-sum competition to be won, even when we've won it, like in Brazil, where we have a surplus. Instead of recognizing that mutually beneficial arrangements should be nurtured and leads to everyone's success. So the result is that America is increasingly isolated from the very global economic networks that we built, that have been the foundation of our prosperity for decades. Because in the game of global economics, if you're not growing together, you're growing apart. And right now, the world is growing apart from America at an accelerating pace. For the MeidasTouch Network, I'm Max from UNFTR. To visit our YouTube channel, you can go to @UNFTR, or to access our directory of progressive resources, archive of original content, or to sign up for our free weekly newsletter, you can visit our website at UNFTR.com. Again, for the MeidasTouch Network, I'm Max. See you next time.
Can't get enough Meidas? Check out the Meidas Plus Substack for ad-free articles, reports, podcasts, daily recaps from Ron Filipkowski, and more. Sign up for free now at MeidasPlus.com.